we do some sort of like master lease with option to buy. And so we're taking over the property, we're running it, we're doing the evictions, we've got our dream team PM in there, we're doing the renovations how we want it, that type of thing. The challenge, there's two challenges there. One challenge is if you're doing master lease with option, there's really no capital injection, right, from investors closing and title and all that stuff. So we would have had to take a private loan, construction loan, something along the lines to get us capital to start doing renovations, exterior capex, et cetera. And that, not impossible, right? But we'll just call it a barrier.
As an operator, I know other investors are romanticizing multifamily investing, and I'm looking to learn from other investors' mistakes. I know you are too, and you found the right place. Welcome to Myers Methods Presents Multifamily Missteps. Hey everybody, and welcome to Multifamily Missteps. I'm your host Jerome, and I have the pleasure of having Tommy Brant in with me today. Tommy, how are you, man?
Jerome, man, I'm great. Short answer is I'm great. You've had a lot of superstars on this podcast here, so I'm really just truly humbled and honored to be here and have an opportunity to contribute to your listeners.
Man, that contribution is the ultimate gift. So, for the listeners who may not know about you and where you've been and what you've been up to, give them a little bit, man. Let them know who you are.
For sure. Yeah. So my name is Tommy Brant. I'm a recovering electrical engineer based out of the Nashville submarket. So I've been here 13 years last January, ever since I graduated Georgia Tech. I went full-time in real estate last August. And so with a focus on multifamily syndication, but I got a portfolio consisting of some single family long-term, single family short-term, invested in a couple apartment syndication through some chips on a new development deal. And I'm a joint venture on a storage facility as well.
Wow. You're rocking and rolling, man. You got the income coming in. That's awesome. So through all of those, so those are the deals you own. I guess you just bought everything you looked at, right?
On the single family side, it took me a while to figure out what fit my buy box there. But I'm an LP in 2 apartment deals, LP on a development deal, and I guess one of the things we're going to talk about is my first GP deal that eluded me. So a lot of emotional turmoil that I've gone through on that one, but we've got a couple in the hopper, so we recovered just fine.
Recovery is part of the game. If you don't give up, you can't lose. So talk to me about this deal. Where was it? What happened? Like, give us the backstory.
For sure. Yeah. This, oh my gosh, Jerome, it came in and it was just like, it fit everything we'd been looking for. And so this was about, I guess I'll break it down for you. So this was a pocket listing from a broker, came in on Sunday, and then we were under contract, had the team identified just because we knew the market. The property was in a submarket of Nashville, 52 unit apartment complex. And we're like, okay, this is a good size for us to take down with a small, intimate team. And we were under contract executed by the following Sunday. And so within a week, we had the team assembled, we had it underwritten, we knew it was a deal, we had a couple of lenders picked out, and then we knew who our property manager was going to be. And so that's one of those things where it's like, I can't be dabbling and be able to move that fast in a week's time. And so it helps that you're focused on your market first, and then you're assembling the team around your market. So that was a good time. So that's kind of how we sourced the deal. There's been really just one broker that we've been building a relationship with for the better part of a year. And so that really came to fruition with that deal. And so we had a pretty good idea who all had seen the deal. And we just assembled a team around the strongest players that had access to that one. So
wait, so I've never heard that strategy. So you went to the other people who you think the broker shared the deal with and said, hey, instead of competing, let's collaborate.
Yeah. And one of them is more or less like the favorite, of this broker. And so, and we'd been, making some offers on other properties together. And, and he's super busy. And so we're like, all right, we'll do, the underwriting 12 different ways possible. We'll do the market analysis, we'll do the investor deck, investor relations, all that good stuff. We just need you to sign on as, experience, and just have your name on a piece of paper. And so I think it was, we had underwritten it a number of times. Like I said, we got it on Sunday. We'd underwritten it a number of times, got the heads up on what are the new developments coming to the city, this, that, and the other. And we brought it all to him on Tuesday. He said, like, this is everything that we know. He's like, I like it. I think y'all are conservative here, here, and here, and here. I think there's a lot of upside to this deal. By the way, I think I got some connections that are really good on the lending side. I think this is going to make this a screaming good deal at this purchase price. I'd like to participate. You sleep on it, and y'all let me know if y'all want me part of the team. And so my partner and I, we talked after that. We're like, okay, this is a no brainer. We know we want them, but what are like the obvious gaps? And we're like, all right, well, we need, a seasoned asset manager. And he was like, I know a guy. And so we've just assembled a team in short order, based off of what we knew at the time. But yeah,
that's outstanding. So I think this is a key point for the listeners, because folks who are doing their first deal, trying to lead their first deal, think that they're just going to join somebody else's team and everything's going to be great. But you took the deal, you took action, figured out the underwriting, decided that it wasn't just a lead, but truly a deal, then presented that to somebody who had more experience than you did. And they were like, I'm interested in joining the team. So you created value for yourself in just that part alone. Is that correct?
You know it. Yeah.
And so who wrote the contract? Was it you and your partner? Was it some entity that you guys created? Was it the favorite, in air quotes? Who was the guy, or who was the lead on that?
Yeah. So as far as signing on the contract for initial one, that was actually just me. He was like, I don't think I need to be on the initial one, and we'll do a DBA later on, doing business as later on, after we get an LLC form through syndication and all that good stuff. So that was just my name on the initial one, but we kind of came together and we said what terms that we wanted, right? We wanted the ability to buy 30-day extensions with more earnest money down, contingent upon satisfactory inspection, kind of the normal stuff. That we didn't have to do hard money or anything like that, because it was just kind of like, the broker was just like, I just want reasonable buyers. I've dealt with a lot of buttholes in the past, and I just want people I like to work with, which is refreshing that that's still out there, and they're not, pushing price and highest and best, this, that, and the other.
Okay. And so it sounds like everything's going perfectly, like every other deal. Like, this is just how it's supposed to go. Broker gave me something I can work with. I got the team I need. You guys should be riding off into the sunset, mailbox money every month.
That's it. That should be the case, right? In my mind, like, that definitely should be the case. And so I guess we get to where we're doing due diligence and inspection, and we were a little concerned about the roofs, and the interiors of the building. And so we get to inspection day. And it really wasn't anything that we couldn't navigate, right? The roofs definitely need to be replaced, but we had budgeted $250,000 just for the roofs of all these buildings. So we're like, okay, no real surprise there. But the thing that was surprising was that the roof inspector was like, there'd been some recent storms, could probably just get them to file an insurance claim. You pay a higher premium than you want, but you wouldn't have to pay $250,000, up front. You would pay it and just, a higher insurance as you go, and that'll casually drop. But the thing that was really surprising was just the foundation issues, just a number of them. There was 13 quadplexes that made up the 52 units. They all had they had a door on the rear and the front as well. And so that kind of made up the breezeway, if you want to think about it that way. So it was breezeway. But there was, just 13 buildings with 2 entrances on them, and the doors were always open. So inclement weather, rain gets in, no one's shutting the doors. There's low security, things to worry about there. And so it really just kind of translated to foundation issues. Again, not really anything we couldn't navigate. We asked for, an extra $150,000 in repair concessions. They were, a little slack jawed at it, but it was kind of their fault, right? They'd owned the property for 2 years and hadn't done any. Yeah, they hadn't done any like CapEx injection to the property. So it's just like it was funny because we had the inspector that they had when they bought the property 2 years ago. And the guy's like, nothing's changed.
Same report. Here you go.
We actually got a discount for it. He's like, there's a lot that I can reuse. So and he knocked like half off the inspection. So it went from, 4,000 to 2,000 on the inspection report for 13 buildings, crawl spaces. So, sampled electrical panels, which is, we took that. But then we also, I think we ended up with like 1,500 pictures on inspection day. And so there was a couple of stuff that we added to the inspection report. There's like, okay, well, he missed this crack in this foundation and where these cats were torn up the AC ducts under the house and stuff like that. So it's good that we did our extra due diligence there. But like I said, we had asked them to, instead of us paying for the roofs, please exercise an insurance claim. Here's a roofer that can help you do that. By the way, can we get some money off of the purchase price or just cash back credit at closing, that type of thing. And so he begrudgingly agreed to all of that. And then we started getting more of the intimate accounting details. And this is really where it started going south, Jerome.
Okay.
And so
well, how'd you underwrite it? Wait.
Okay.
Wait, now the broker put something together for you guys. You got some financials, you did your model, and now you go do your due diligence and the way we teach it. And I think the way you're doing it is after you did your due diligence inspection, you had to go back and sharpen your pencil and see what you're actually buying. Cause what the broker gave you with this new information, things may be different. Am I right?
Sure. Well, with the cashback at closing, that kind of made it all tolerable. So they're like, financially speaking, based off of due diligence and inspection, like we really weren't much different than going into it after concessions, right?
The knowledge, deal flow, experience, and capital to be successful. They often try to overcome these challenges out of order, slowing or eliminating their ability to get the next deal done. We have developed a framework that allows them to gain the knowledge they need to find profitable deals. When they use our system, they create time and location freedom, as well as the generational wealth they desire for their family. The Multifamily Kickstart program has proven to be the fastest way to establish credibility and build a profitable apartment portfolio. Hop over to jeromemyers.co to find out more information.
You found out some stuff during financial due diligence on what was presented to you? Is that?
For sure. Yeah. And so
come on, give it to me. You're holding out, man. Come on.
So I guess some of the backstory is the short of it is there's over $120,000 in delinquent rents. So pause for that, silent memory. And so the backstory there is that the PM franchise out of Nashville that was brought on to manage the property, they hired someone local to the property. They actually hired a tenant that lived at the property to manage the property. And so it got to where they missed a rent payment and didn't get audited, didn't get, bank rec or anything like that. And it was just like, they realized they were the hammer, right? And if they're not coming down in their self, then so they missed another one. Then they just got to where they just blatantly not paying rents. By the way, they're telling their roommates are talking to other people. And so it got to where they were effectively like coaching people on how to not pay. They're like, send me a check, I just won't cash it. And so it got out of control. So I think that we showed about half of the tenant base wasn't paying for multiple months at a time. There's also, people filing for housing assistance and stuff like that. And when it gets to be something like that, the payments get lumpy. And so that was where I guess options at that point were there could be a substantial discount on purchase price to convey the risk. The challenge was the person that bought it before also syndicated. And they said, well, if I'm going to sell, it has to be at this range. Otherwise it doesn't make sense for me to sell and incur a loss. And, it's just easier for him to hold on to the property. Right. And so the other alternative at that point is we do some sort of like master lease with the option to buy. And so we're taking over the property, we're running it, we're doing the evictions, we've got our dream team PM in there, we're doing the renovations how we want it, that type of thing. The challenge, there's two challenges there. One challenge is if you're doing master lease with option, there's really no capital injection right? From investors closing and title and all that stuff. So we would have had to take a private loan, construction loan, something along the lines to get us capital to start doing renovations, exterior CapEx, et cetera. And that, not impossible, right? But we'll just call it a barrier. The second challenge is there's really nothing to stop the owner from just saying, you guys have done such a great job, sue me, and suffer in court for multiple months, or God forbid he gets hit by a bus and now it becomes an estate situation, and the kids are like, no, I don't want to sell this, and you need my approval, and by the way, you need my sister's approval, and anyway. So we talk about risk. It got to where master lease just didn't really seem feasible. We didn't know the guy; he was out in California, and there was just no, we'd never done business before together, so we didn't really see the master lease with option taking other people's money into a deal like this as being the way. And then the other option was to back out. If that was we talked about it a little bit, but if this was a JV where we were bringing our capital into the deal and we acknowledge the risk, but also acknowledge the upside, like there's probably a world where we would have done it, but we were planning on syndicating. We already had the PPM written up and stuff like that, and taking other people's money into a deal at that risk level, like it just didn't, I don't know. It was just outside the box,
Yeah.
So we
how
canceled the
much
contract
money
on
did
that.
you have in the deal? I mean, if you got a PPM, you got an inspection, you might have an appraisal paid for. You may have paid a bank fee at this point. Like, I mean, how much money did you have at risk at this point?
Yeah. So we had put 41,000 for earnest money. We had put in 15,000 for like syndication fees, legal fees, stuff like that. Inspection was 2,000. The earnest money was refundable, so we did end up getting that back. The syndication fees, that is still paid for, and so that's lingering. And so the idea there is, as long as us 4 individuals do another deal in the future, we can cut a doing business as and reuse that money. And so as of right now, we haven't recouped those losses, but the idea is that whenever this property gets corrected by the current owner and we revisit it in 6 to 9 months, it'll go into effect. We'll see. And then the inspection report, right? That's basically $500 out of pocket for everybody. So we kind of see like the net loss right now as $500 per person, because we're all still interested in this property. We got a recent appraisal at around the purchase price, so we think we can still buy it and make sense out of it if we can get the loan product that we want. So, but yeah, I think gross losses at this point is floating around 17 if we don't get together as a back as a team.
Wow, that's not terrible.
Yeah,
but
we didn't have hard money, and so not as bad as a lot. There was another property in Nashville where there was a team in Arizona that had a property under contract, and it was like over $200,000 hard, and they walked away from that deal. So it's not not nearly as bad as what I hear going on in the market nowadays. So I consider this tame.
Wow. Okay. And so have you made any changes to your process that will keep you from losing this type of cash again, or making mistakes with financial due diligence?
Yeah, Jerome, there's one big takeaway from me, but it actually doesn't have a lot to do with this deal, but it's more just my thoughts around hard earnest money. And so so I think part of the reason this deal didn't work out is because the previous operator wasn't operating like they should have, right? It just didn't look like they had a business plan, right? They didn't have local boots on the ground. They didn't execute any sort of CapEx or business plan or anything like that. So if they would have done everything as I learned it, at least, I think we could have transacted. I think it would have been great. But there's, a red flag on the operator here. And so when it comes to hard earnest money, nowadays, it's like, people will look at a deal and then they see an asset and they see the upside, and they're like, oh, this asset, this real estate business is going to be great when it's in my hands. I will gladly put hard earnest money down. But my conclusion in all of this is like, you really need to be understanding the previous owners. What are the sellers? What are the operators like? Did they have a business plan? What did they neglect? Is there a theme that we're seeing in all the units with just, neglected plumbing, or nobody's replacing flooring, or nobody's executing some aspect of the business plan that is blatantly obvious to you that should have been executed? So whenever people are talking about hard earnest money, I want to know the owners just as much as I want to know the asset.
Well said, because the current owners are the ones that have created this situation that's there. And I say owners, but I think property managers, asset managers, and owners all work together as one in operating or executing the plan. So the final question I want to ask everybody is, what words of wisdom do you have for the listeners?
I guess I'll leave it to those that are looking to get started. Generally speaking, just get educated, and then pick your market, and then network. Always be networking, right? So always be, talking to other people, whether you're looking for new investors or new partners to start up your company with, or just like-minded people to keep you motivated. So always be networking for sure. Looking for mentors in the space as well. Just always be trying to find something that can help you get 1% better every day.
Okay. And Tommy, the listeners who are like, man, I got to learn some more from this guy, how can they get in contact?
For sure. I appreciate that, Jerome. Yeah. And my name is Tommy Brant. I'm Brant as in Tommy. And I'm on Facebook. I'm on LinkedIn. I will be on YouTube one day. I'm not there yet. I'm still growing. I'm still adulting there. I guess if you want to check out what we're doing, you can check us out at tbcapitalgroup.com. I'm also wrote a book for your listeners. So, I am an engineer. It is very detail oriented. So I can't help but be detail oriented, but it's called The Passive Investor's Guide to the Multifamily Universe. And so that is my gift to anyone that takes a look at the website there. And so I do not monetize that. Y'all can go grab that at your leisure.
Awesome. Tommy, great learnings. Solid process, man. You said you learned how to do it. You learned well. Obvious you went through some formal education, man. So I wish you a ton of luck, and hope you guys get to reuse that PPM, because that's money well spent. To the listeners, the pack's with you. We'll talk soon.
You made it to this juncture, so you really love what we shared on this episode of Myers Methods Presents Multifamily Missteps. Do us a favor, give us a 5-star rating, give us a review, and share this with somebody who's interested in multifamily investing. Until the next time, the pack is with you.